Our next guest finds cyclicals attractive over defensives and growth names. Citigroup U.S. equity strategist Scott Chronert, S&P target of 5,100, joins us here at Post 9. Welcome back. Good to see you.
Good seeing you as well.
So it is interesting that we continue to see these new highs on the S&P, even though bond yields have been creeping up. I mean, we're not seeing any kind of outsized moves, but it used to be that we needed bond yields to fall for the S&P to rally. What's happening?
So I think there's a few things going on. So, we had the big rally in Q4 that I think was premised on the 10-year nominal fall from 5 down to 3.6, 3.7. That triggered the broadening effect that we still think is part of the 2024 narrative, right? It's taken a little bit of a back seat here to start the year as a function of, as you described, the backup in rates again. So we have to keep an eye on that. We continue to think that the 10-year nominal is more important directionally for the S&P than is the Fed funds discussion. So I think that's very consistent with the way we're seeing the playbook play out, set up for 2024.
So the current thinking is that the Federal Reserve will start cutting second half of the year, maybe toward the end of the first half of the year. Does it matter when and how many cuts we get? Because if the market is off on that, then couldn't we see a correction?
So I think we've been arguing that the start of the year, we were going to go into Q4 reporting period. We're going to get positive surprises akin to Q3, but you ought to see full year 24 expectations in general come down as C-suites continue to express some general concern about macro conditions. So what we had been expecting is sort of a weaker start to the year, then followed by a stronger mid-year as you get to that Fed pivot point. Whether it's March or May, June, the house view at Citi is sort of a June first cut. It's coming. I think the inflation data tells you that. And I think we got pretty high conviction that this just a fait accompli as to when and how much. Ultimately, what I really want to see is the Fed begin to talk more about lessening their restrictive approach to the economy and getting closer to something approaching neutral, which is a tough position point on Fed funds to really target at this point.
Waller kind of started down that road and then put some walls around his commentary in the last couple of weeks. 5,100 is 4% away. Do you feel any pressure to raise your target?
Not yet. So we're ahead of consensus on our earnings expectations for 2024. No change there. We're using a 245 estimate. 5,100 is 21 times that. Now, we can talk about valuations if you want, but we're pretty comfortable where we are. Our point here is we want to be in U.S. equities. It's a question of where and how and when. We're looking for pullbacks to be more aggressively buying into. Holders of growth, we think that the latest NASDAQ rally is predicated more on continued euphoria on the fundamental front, more so than valuations. Got that. But we think that the next leg of this is going to have to be a broadening down the cyclical side.
We're not getting the broadening yet. I mean, I'm looking right now. We've been kidding about not including Tesla anymore in the Mag 7. It's up today. But NVIDIA is up another 3.5%. Yeah. It's up 25% this year. Meta's up 11%. This is a Mag 7 market again.
Well, it is for now. Okay, I think we had the Q4 broadening in November, December. To Sarah's point, we're table pounding bullish on the industrial economy. And part of what we're focusing on here is that we think the inherent cyclicality of that part of the market is much less than historic. And the AI influence is part of the discussion here. The ability to manage supply chains much more real time. So, David,
buy industrials for AI, not for the economy?
Buy industrials for what I think is to be lesser cyclicality than is commonly perceived. And I think that's going to end up being a multiple enhancer for that part of the market. So you've talked about retail. Now, we've recently upgraded retail to an overweight. It's premised on the same thing. The productivity enhancements that are coming more broadly across the market, I think, are going to be a pretty big deal. Yes, you're going to measure tech. You're going to measure a lot of the big seven on the actual fundamental dynamics and implications of AI, but you're going to see it more broadly over time, I think, across the broader economy, and you're going to see it in margins and profitability.